Hello everyone, it's Thursday, November the 3rd, and I'm David Song, currency analyst with DailyFX.com. And a very interesting day of trading that we have here. Indeed, we saw the ECB surprise and actually deliver a 25 base point rate cut, which brought down the benchmark interest rate to 1.25%. So we actually have the press conference with new ECB president Mario Draghi underway right now, and some very dovish comments coming out of the ECB. So we'll take into consideration of all the things he's saying, as well as look at the price action here for the euro. So we saw the euro give back that overnight advance all the way to 138.34. So it looks like another failed run at the 61.8% Fibonacci, right around that 138.80, 139 level. But in terms of what we're hearing from the ECB, we actually saw the ECB said that the euro area actually faces a mild recession, and thereby holding a really weakened outlook for growth and inflation, saying that ultimately the growth forecast could be, or actually will be, revised lower over the months ahead. So we do have that on tap. But right now, especially as we do have the EU summit coming up, just a lot of uncertainties surrounding the fundamental outlook for Europe, not only in terms of the economic assessment, but also in terms of the sovereign debt crisis, and really just a lot of uncertainty surrounding the Greek referendum. So we'll have to see how things continue to pan out there. But we're seeing a pretty dovish statement from the ECB. So, taking into account of pretty much all the things that we are hearing from Mario Draghi, suggests that we could see some more easing over the coming months. Not only that, it seems as though we'll see the ECB carry its easing cycle into the following year, given that we are seeing a greater risk for a double-dip recession in Europe. So, in terms of that, and especially as we do see this near-term, or as we do see the euro continue to trade below the 61.8% fib, I do think that we will see it continue to give back those advances that we saw from back in the previous month around that 130 and 145 level. So right now, just looking for a test of this 50% Fibonacci right around that 135 level. But once we get below there, indeed look for a test of this 38.2% fib right around that 131 level. But over the weekend, we'll have to keep a close eye on the G20 meeting, especially as as the sovereign debt crisis will take center of attention during the meeting. So we do have that. So we do expect to see some more developments coming over the next few days in terms of the sovereign debt crisis there. So we'll have to see. We might get a relief rally should we see the international community look to support the euro area going forward. But again, don't want to get too ahead of ourselves, and we just want pretty much have to just wait here and see on what further developments we'll see coming out in terms of the debt crisis. But taking a look at the pound, really market sentiment is really tapering off right now. Not only did we see all these developments coming out of the euro area, but we did get the US ISM non-manufacturing report, which missed expectations, and we actually saw it come in much weaker than expected. Let me get you guys the reading. It came in at 52.9. And that was really we were actually looking for a print of 53.5, so way below forecast. So really appears to be weighing on market sentiment. Really taking into everything account today, and we might see this shift away from risk-taking behavior continue to gather pace throughout the remainder of the day. So for the British pound right now, appears to have carved out a near-term top just ahead of this 23.6% Fibonacci, right around that 162 level. So as we did see it fail to hold above the 200-day moving average, now it looks as though we'll see it continue to come back to the downside. It looks to be finding some near-term support right around this 158.90 level, 159 level, but we probably won't see some solid support come in until we get to this 38.2% fib, right around that 156.80, 157 level. So some more downside risk for the pound dollar in the days ahead. But really, as the economic docket for the UK remains pretty bare for the next 24 hours of trading, we'll have to keep a close eye on the Non-Farm Payrolls report, which is due out on tomorrow. So again, my colleague David Rodriguez will be covering that. So it should be a very interesting print, as we're expecting U.S. employment to increase 95K for the month of October. But that brings us to one of my favorite pairs here, the Euro Pound. We're seeing it really just quickly retrace that advance from the previous day, working its way back towards this 85.50 level. But nothing really, or might see a run at this 85.30 level, which is held up as support just since all the way back in September. So some more downside risk should we see a test of there. Get ready for a good correction, but right now, keeping a closer eye on the Euro Loonie right now. Right now, it seems as though we could see a good pop here. Ultimately, maybe even a breakout. Especially as we do see price action fail to hold below the 200-day moving average once again. So, again, we were looking for some support right around this 138 level, and really as it continues to maintain this range between 138 and 141, again, still looking for a breakout here. I prefer a breakout to the upside here. Again, watching this broader upward trending channel that was carried over from earlier this year. So we'll have to keep a close look at that. But again, right now just waiting for some momentum to build up in this pair. But a good range here that we could certainly take advantage of. But again, I prefer trying to play to the upside rather than trying to fade some of these advances here for the Euro Loonie. But taking a look at the other major counterparts right now, Kiwi, we saw it tip lower after we saw that weaker than expected employment report, but really coming under pressure right now. And right now we're seeing this kind of global theme where a lot of these major industrialized countries are facing a risk of a double-dip recession. So in turn, we might see that really become a global theme. And right now, we'll have to keep a close eye on how risk sentiment really continues to pan out over the remainder of the day, but it seems as though we'll see risk continue to taper off, so in turn could see some more Kiwi weakness over the day, could see a potential run at that low, that overnight low of 78.05, so keep a close eye on that, but it certainly looks very toppy after we saw it fail to hold above that 100-day moving average coming into November. So now looks as though we should see this reversal from that 82.40 level, gather pace in the days ahead. Similar story here for the Aussie as well. Looked very toppy after we saw a failed run at that 108 level, and now trading back below this 23.6% Fibonacci, right around that 103.70, 104 level. So in turn, and especially as we do see the RSI continue to come off of those highs, should see some lower prices. I'm keeping a close eye on this 38.2% Fibonacci, right around that 99.20, 99.50 level for some near-term support. So still a lot of downside room for the Aussie, and for the Aussie dollar, we have to keep a close eye on risk. In essence, as we do have a pretty much bare economic calendar for Australia for the remainder of the week, so keep a close eye on that. But taking a look at some of the other major counterparts, dollar loonie, again, found clear support right around the 78.6% Fibonacci, and certainly moving its way back to the upside here. So could finally get a break above this 102 level here, which has held up as sort of resistance over the last few days. So watch for a break above that, and should we get above that 102 level, again, we might see it make another run at the 61.8% Fibonacci, right around that 105.70, 106 level. So it seems as though we're going to see some more US dollar strength over the near term in terms of the technical moves, or in terms of the technical developments that we're seeing across the board right now. But again, have to watch that NFP report tomorrow again. So it seems as though we're going to see some interesting round of trading still over the next 24 hours of trading here. But taking a look at some of the other majors here, dollar Swiss. Carefully watch that 20-day moving average here. Again, we got that trading signal earlier today recommending shorting the dollar Swiss, but again, I was saying be careful and really beware of the ECB interest rate decision, as we do see the Swiss franc move inversely now with the euro dollar, and as a result, we saw that pop in the dollar Swiss. But as it continues to hold below, or as it really struggles to get back above that 20-day moving average, it seems as though this reversal should gather pace over the near term. But again, we don't want to get too aggressive with trying to sell the dollar loonie, or actually the dollar Swiss, given that we are seeing the Swiss National Bank keep a lid on the Swiss franc. So could potentially see a test of maybe this 85 level, but again, more realistic target here is, I would say, look for a retracement from that rebound of 85.68, and we could certainly get lower, but it definitely looks as though we'll see price action hold below that 20-day moving average going forward here. But dollar yen continues to pair the intervention that we had from the finance ministry, but again, don't get too aggressive with this trade either, especially as we do see Japanese policymakers really increase their efforts to stem the market depreciation in the local currency. So I want to say there is certainly some a risk of seeing more interventions going forward, but right now, for the dollar yen, it seems as though we'll see it really just hold this narrow range, especially after given that intense volatility just earlier in this week. But again, as we had this pretty dovish ECB rate decision, as well as some weak data coming out of the U.S. economy. It seems as though we'll see the shift away from risk-taking behavior at pace. Although we are seeing the U.S. equities market has come off of those highs, it's still trading in the green, while the S&P at 500 and the Dow are, but right now Nasdaq is in the red. So we'll have to see how risk sentiment really holds up throughout the day. But again, don't be too surprised if you do see things cool off ahead of the Non-Farm Payrolls report tomorrow. And again, we're expected to see a rise of 95K in U.S. employment after we saw that 103K rise during the previous month. But should be very interesting. Of course, Non-Farm Payrolls is one of the biggest market movers. So again, we're very excited to look into that tomorrow. And again, my colleague David Rodriguez will be covering that in the Daily FX live trading room tomorrow. So I encourage everyone to join him for that. It should be a very interesting round of trading over the next 24 hours. But that's all I have for today. I just want to thank you for joining me and want to wish everyone good luck in trading.